Welcome back to the deep dive. So, when you look at the annual report for some huge company,
hmm
those big numbers, they actually roll up hundreds of smaller businesses, right?
Absolutely. They've all consolidated.
But the really important statements, they're not always the simple ones you might read first. They often involve, well, ripping up the individual company books and starting over
It's a
almost.
complete rebuild in a way. You're creating a picture of a single economic entity.
Exactly. So today we're doing a deep dive into creating what you might call the super statement, the Consolidated Statement of Financial Position, the CSFP.
That's precisely the mission.
Yeah.
We're taking the separate financial statements of a parent company, let's call it P,
Okay.
and its subsidiary S, and merging them. The key is treating the whole structure as one single economic entity, erasing those artificial boundaries between the legal companies.
So ignoring the fact they're separate legal entities for this purpose.
For reporting purposes, yes. The goal is to prepare a CSFP for a simple group, maybe P and one or two subsidiaries, and really understand the true value P acquired.
Right. And this is where it gets pretty complex because it's
Okay.
not just adding things up line by line, is it?
No, definitely not. Simple addition would be misleading.
You've got these consolidation adjustments, really significant ones. Like first, figuring out the value of the part of the subsidiary the parent doesn't own.
The non-controlling interest, or NCI.
You're right, the NCI. Then second, you have to calculate goodwill, that sort of premium paid for the business beyond its tangible assets.
The intangible value, exactly, often linked to reputation or synergy.
And third, and this sounds like a major task, hunting down and eliminating all the internal stuff, loans, sales between P and S, that kind of thing.
Intra-group transactions,
Yeah.
they absolutely have to go. You can't profit from yourself.
Because if you don't, the whole financial picture is just
No.
wrong, skewed.
Wildly overstated, potentially. It wouldn't reflect the group's performance with the outside world.
Mm-hmm.
So let's lay the groundwork first. The basic principle is actually quite straightforward.
Go.
The CSFP must show all the assets and liabilities of the parent and the subsidiaries. Everything the group controls.
Nothing gets left out just because it sits legally in the subsidiary's books.
Correct. Because the parent controls it, it's part of the group's resources.
But the crucial first step, you mentioned elimination, that sounds key.
It is. Think of it like a family budget analogy. If you lend your spouse 50 quid, the family unit isn't actually any richer.
Right. It's just moved from one pocket to another.
Precisely. So we have to eliminate these intra-group receivables and payables. If P owes S 10 million or S owes P 10 million, that debt disappears from the consolidated statement. Gone.
So you only show debts owed to or by parties outside the P plus S group.
Exactly. Only external transactions matter for the group's overall position.
Okay. So after you do that initial sweep, what does the basic structure look like?
Well, the consolidated statement will show the combined net assets, all the assets minus all the liabilities of the whole group, parent plus subsidiary.
Makes sense.
But here's the first big consolidation adjustment, a really core one. The share capital shown on the CSFP is only the share capital of the parent company, P.
Hold on. Why? Why do we just ignore the subsidiary's share capital? Didn't P pay for those shares?
They did pay for them. That payment is P's investment in S on P's own balance sheet.
Right.
But if we showed P's investment asset and also added in S's share capital equity, we'd essentially be counting the same value twice from the group's perspective.
I see. Double counting.
Exactly. So the consolidation process cancels P's investment asset against the net assets acquired in S at the date of acquisition. You replace the investment line item with the actual underlying assets and liabilities you bought.
Okay, that clicks. You swap the placeholder, the investment cost, for the real stuff, the subsidiary's assets and liabilities.
Precisely. It reflects the economic substance over the legal form of the transaction.
So what about retained earnings then? The profits?
A good question. The group's retained earnings become a combination. It's P's own historical profits plus P's share of S's profits earned since the acquisition date.
Only the post-acquisition profits from S count towards the group's ongoing earnings.
Critically important distinction. S's pre-acquisition profits are part of what P bought, effectively capitalized within the goodwill or net asset calculation at acquisition. They aren't part of the group's subsequent performance.
Okay, let's really unpack the acquisition itself then. When P buys S, you said the cost of acquisition kicks off this whole process, and it forces us away from simple historical costs into fair values.
That's right. The moment P acquires S, we need to think in terms of fair value. IFRS 13 gives us the definition, basically the price you'd get selling an asset or pay to transfer a liability in a normal market transaction.
So what the assets and liabilities are worth today in the market, not what S paid for them years ago.
Exactly. It ensures we're valuing the acquired business based on its current economic worth to the group at the point P took control.
And the cost of that investment, P side of the deal, it's not always just straightforward cash, is it?
Often not. It can definitely be cash paid up front. But P might have issued its own shares to S's former owners, a share exchange.
How do you value that?
You use the market price of P shares at the date of the acquisition. That reflects the actual value P gave up.
Okay. And you mentioned deferred or contingent consideration. That sounds interesting.
Yeah, that adds complexity. Deferred consideration is basically a promise by P to pay more cash later, maybe in a year or two.
So like an IOU as part of the deal?
Kind of. But because of the time value of money, you can't just stick the future amount on the balance sheet today. You have to calculate its fair value at the acquisition date.
How? Discounting.
Exactly. You discount that future payment back to its present value using an appropriate interest rate, often P's cost of capital. That discounted amount is the liability P recognizes immediately.
Right. And that liability doesn't just sit there unchanged until payment, does it?
No, absolutely not. Each year, as time passes, you have to unwind the discount.
Unwind.
Meaning you charge an interest expense to the group's profit and loss and increase the liability. So by the time the payment date arrives, the liability equals the full amount due. It reflects the financing cost of delaying the payment.
Got it. So fair value is key for the payment side. But what about S's assets? This is where you said it gets really interesting.
Yes, this is a huge part of consolidation. Every single identifiable asset and liability of the subsidiary, S, must be revalued to its fair value at the acquisition date for consolidation purposes.
Every single one. Even if S uses historical cost in its own books.
Doesn't matter what S uses internally. For the group's consolidated statement, historical cost in S's books is irrelevant for assets held at acquisition.
Right.
We need the cost to the group. And the cost to the group was the fair value P effectively paid for those assets when it bought S.
Wow. So if S bought land 10 years ago for $1 million, but it was worth $10 million when P bought S.
It goes into the consolidated accounts at $10 million. Absolutely.
Yeah.
This applies across the board: land, buildings, machinery, even inventory, if its fair value differs from its book value. And liabilities, too, potentially.
That fair value uplift must have big knock-on effects, like on depreciation.
Huge effects.
Yeah.
If you uplift a building's value, the subsequent depreciation charge in the consolidated accounts will be higher based on that higher fair value. It properly matches the consumption of the asset's value acquired by the group.
Okay, so this focus on acquisition cost and fair valuing everything, it leads us straight into goodwill, doesn't it? That premium you mentioned.
It does. Goodwill is defined in IFRS 3. Think of it as an asset representing future economic benefits that come from assets acquired in a business combination that you can't individually identify and separately recognize.
So things you can't put your finger on easily, like the company's great reputation or its skilled workforce or maybe potential synergies.
Exactly. Those kinds of things. The value of the whole business being more than the sum of its identifiable parts.
So how do we calculate it? You compare the total value given for S.
Right. The total consideration P transferred, measured at fair value, plus the value attributed to the non-controlling interest.
Okay, the whole value of S.
And you compare that total value against the fair value of S's identifiable net assets at the acquisition date, those assets and liabilities we just talked about revaluing.
And the difference, if positive, is goodwill.
That's positive goodwill. Now, there's a choice in how you value that NCI component, which affects the goodwill calculation. Two main methods.
Right.
Method 1 is the proportion of net assets method. Here, you only value the NCI based on their percentage share of the subsidiary's identifiable net assets at fair value.
So if NCI is 20%, they get 20% of the net assets value, and that's it.
Correct. This method calculates goodwill that's only attributable to the parent, P. It usually results in a lower goodwill figure on the balance sheet.
Okay. What's the alternative?
The fair value method. Here, you try to determine the actual fair value of the NCI shares at the acquisition date. This might be based on market price, if S's shares are traded, or other valuation techniques.
And this gives a different goodwill number.
Yes, because you're now including the NCI share of any goodwill. The total value you compare against net assets includes both P's consideration and the NCI's fair value. This usually results in a higher full goodwill figure.
Why choose the fair value method then? It sounds like you're booking goodwill for a part of the company you don't even own.
The logic connects back to control. P controls 100% of S's assets and operations, including the factors that generate the entire goodwill, like the reputation. So some argue consolidating the full goodwill gives a better picture of the total economic resources controlled by P.
Interesting debate there. Now, what happens to this goodwill once it's on the books? It's an intangible asset.
Yeah.
Do we amortize it like other intangible?
No. This is a key point and sometimes controversial. Under IFRS, positive goodwill is not amortized.
Not written down over time.
Nope. Instead, it must be tested for impairment at least annually.
Impairment testing, meaning you check if its value has dropped.
Exactly. You assess if the recoverable amount of the cash-generating unit to which the goodwill relates is less than its carrying amount, including the goodwill. If it is, you write the goodwill down. The idea is goodwill doesn't necessarily waste away predictably. Its value is maintained unless circumstances indicate otherwise.
Critics might say that keeps asset values higher than perhaps they should be. What about the opposite scenario? Negative goodwill.
A bargain purchase. This happens if P manages to buy S for less than the fair value of its identifiable net assets.
How does that even happen?
It's rare. Maybe a forced sale, or maybe P just got a really good deal. But the first step is always to double-check everything. Recheck the fair values of S's assets and liabilities. Recheck the calculation of the consideration paid. Make absolutely sure the numbers are right.
And if, after all that checking, it's still negative?
Then generally, that difference is recognized immediately as a gain in the consolidated profit and loss statement, a nice one-off boost to income. But accountants are inherently skeptical of bargain purchases. Okay, let's talk properly about that other slice of ownership, the non-controlling interest, the NCI.
Right, the part of the subsidiary P doesn't own. If P owns 80%, NCI is the other 20%.
Exactly. Now, crucially, NCI isn't treated as a liability. It's shown separately, but within the equity section of the Consolidated Statement of Financial Position.
Equity. Even though they're outside owners and don't control the group, why equity?
Because NCI represents a claim on the net assets of the subsidiary, which are consolidated in full into the group statement. Since P controls 100% of the assets and liabilities, the NCI share represents their residual interest in those consolidated net assets. It's a form of ownership equity, just not the parents.
Okay, that makes sense. It's their slice of the pie, even if P decides how the pie is managed. And its value isn't fixed, is it? It changes.
No, it's definitely dynamic. It changes over time. You start with its value at acquisition calculated using either that proportionate share method or the fair value method we discussed for goodwill.
Depending on the goodwill policy chosen.
Right. Then, year by year, you adjust it. You add the NCI's percentage share of the subsidiary's post-acquisition profits and other comprehensive income.
So they benefit from S's success after P took over?
They do. And conversely, you deduct the NCI's share of any post-acquisition losses. Also, if the subsidiary pays dividends, the NCI's share of those dividends reduces their claim.
And what about impairment, if goodwill was impaired?
Good point. If the fair value method was used to calculate goodwill initially, the full goodwill method, then any subsequent impairment loss on that goodwill is shared between the parent and the NCI based on their ownership percentages. That would also reduce the NCI balance.
So it really is a live calculation reflecting the minority owner's ongoing share of the subsidiary's changing net worth within the group structure.
Precisely. It ensures their claim on the consolidated equity reflects their share of the results generated since acquisition.
Okay, final hurdle.
Yeah.
And you said this one can be tedious. Eliminating internal profits. This goes back to the idea of the group being one entity, right?
Absolutely. Intragroup trading is the main culprit here. Let's say P manufactures widgets and sells them to S for $100, having made them for $80. P books a $20 profit in its own accounts.
Seems reasonable for P.
For P, yes. But for the group, if S is still holding those widgets in its inventory at year-end, has the group actually made a $20 profit with the outside world?
No,
Yeah.
not until S sells them to an external customer. Until then, the widgets just moved warehouses, effectively.
Exactly. It's like moving cash from your left pocket to your right and saying you're richer. The group cannot make a profit purely by trading with itself. That $20 profit is unrealized from the group's perspective.
Unrealized profit, so we have to remove it.
We have to eliminate it. We make an adjustment called the Provision for Unrealized Profit, or PUP.
Okay, PUP. So if the PUP is in inventory, like those widgets S is still holding.
We need to make two adjustments in the consolidation workings. First, Reduce the value of inventory on the consolidated balance sheet by $20, bringing it back down to the original cost of the group, which was $80.
Right, strip out the internal markup.
Second, we need to reduce the group's reported profit by $20. Where that profit reduction hits depends on who made the internal sale.
So if P sold to S.
If P, the parent, was the seller, then P booked the entire $20 profit initially. So the $20 PUP adjustment reduces the parent's share of group retained earnings.
Okay. But what if S sold something upwards to P and P is still holding it?
Good scenario. If S, the subsidiary, was the seller, then S booked the profit. That profit belongs partly to P, say 80%, and partly to the NCI, 20%. So the $20 PUP adjustment has to be split. You'd reduce P's retained earnings by $16, 80% of $20, and reduce the NCI share of reserves by $4, 20% of $20.
Wow, okay, so you have to track the direction of the sale. Does this PUP adjustment apply to other assets too, and not just inventory?
Yes, absolutely. Particularly non-current assets. Imagine P sells a machine to S for $1 million, making a $200,000 profit on the sale. S now has this machine on its books at $1 million.
But from the group's view, it's still the same old machine, just moved departments, and its cost was only $800,000.
Exactly. So first, you have to eliminate that $200,000 unrealized profit on the sale, again adjusting retained earnings, and potentially NCI if S was the seller.
But there's more, isn't there? Depreciation.
Yes. Because S recorded the asset at $1 million, S will be charging depreciation based on that higher inflated cost.
Which overstates the group's depreciation expense.
Correct. So a second adjustment is needed each year to reduce the depreciation expense back to what it should have been, based on the original cost of the asset to the group, $800,000 in this case. It reverses the excess depreciation charged by S.
That sounds fiddly. You're essentially restoring the asset and its depreciation back to what it would have been if the internal transfer never happened.
That's the goal. Restore the group perspective.
Okay. And one last cleanup item. Those intra-group balances. Receivables and payables. You said we eliminate them, but sometimes they don't match up perfectly.
Right. Often due to items in transit at the year end, P might have paid S, but S hasn't received the cash yet. Or S shipped goods to P, but P hasn't recorded them yet.
So P's payable doesn't match S's receivable, or vice versa.
Exactly. Before you can cancel the balances out, because they must net to zero for the group, you have to make adjustments for these timing differences, the cash in transit or goods in transit. You reconcile the balances first, then you eliminate the matched pair.
If you didn't reconcile first, the cancellation wouldn't work, and you might incorrectly show a remaining balance with what looks like an external party.
Precisely. It's a crucial final check to ensure all internal debts are fully removed.
So we've really unpacked quite a bit there. We've gone through this really technical, but I think strategically vital process of consolidation. We've seen it's far more than just adding numbers up. It involves grappling with fair values at acquisition,
Which sets the baseline cost to the group.
calculating and managing goodwill, that big intangible asset,
And testing it for impairment, not amortizing it.
keeping track of the non-controlling interests share as it changes over time.
Recognizing their equity stake.
And maybe most importantly, day-to-day, meticulously eliminating all those internal profits and balances. Putting all that together gives you, hopefully, a much clearer picture of true group performance and position.
Absolutely. The whole point of consolidation accounting, these mechanics we've discussed, is to strip away the legal boundaries and the separate company viewpoints. It forces you to look at the economic reality of the group as a single unit, what it costs to acquire control, and how the whole thing performs together when dealing with the outside world. Without these adjustments, you'd just have a meaningless jumble of numbers.
It really shows the economic substance. Now, here's a final thought for you, our listener, connecting back to maybe the power dynamics involved. When P acquires S, P's accounting policies usually take precedence, right? If P uses FIFO for inventory and S uses weighted average, S typically has to adjust its figures before consolidation to align with P's policy.
Yes, consistency is required for consolidation. You need like-for-like comparison.
So what does this mandated centralization of accounting policy, this need for the subsidiary to conform, tell you about the inherent power dynamic within a group, and perhaps what hidden risks might exist if you only ever look at the individual company statements, which might use different policies compared to the demanding but arguably more truthful consolidated group report? Something to think about.